It wasn't a sudden spike in industrial demand. It wasn't a speculative frenzy driven by retail traders. It wasn't even a momentary supply shock from a single mine closure. It was the oldest arbitrage in monetary history. The relationship between gold and silver is not random. It is a rhythmic, oscillating signal of systemic health. When the system is stable, the two metals drift apart. When the system fractures, they snap back together with violent force. The pattern is unmistakable. The arithmetic is merciless. History does not merely suggest which metal leads. It dictates the sequence. First comes the preservation of kings, then comes the panic of the people. Gold moves first, silver moves furthest. To understand the trajectory for 2025 and 2026, we must look at the precedent. We must examine the moments when empires realized their currency was dying. We look to three specific historical files: the Roman Empire, the Spanish Empire, the Weimar Republic. Consider the Roman crisis of the 3rd century. The peak dominance of the Pax Romana was built on sound money. The aureus was pure gold. The denarius was pure silver. But imperial costs were unsustainable. The legions required payment. The bureaucracy required funding. Nero began the debasement in 64 AD. He reduced the silver content of the denarius. It was the chosen monetary shortcut. By the mid-3rd century, under emperors like Gallienus, the currency was a fraud. The silver coin was merely bronze washed in a thin silver coat. The resulting inflation was catastrophic. Prices soared by 1,000%. Here's the critical distinction. The elite held gold. The aureus retained its purity and its purchasing power. The soldier and the shopkeeper held silver. They were trapped in the debased currency until they fled into physical goods. The flight into hard assets became a stampede. The middle class was priced out of existence. Social fracture followed. The incentive was survival. Gold preserved the dynasty. Silver became the volatile instrument of the desperate masses, just like the Roman Empire. The Spanish Empire of the 16th century faced a similar reckoning. Under Philip II, Spain controlled the world's money supply. They discovered the massive silver veins of Potosi in 1545. The empire was flooded with silver. The cost of maintaining a global empire was astronomical. Wars in the Netherlands, conflicts with England. The monetary shortcut was extraction without production. They imported money rather than creating value. The resulting inflation is known today as the price revolution. Because silver was abundant relative to gold, the gold-to-silver ratio expanded. Gold became the anchor. Silver lost purchasing power rapidly against goods. Land prices skyrocketed. The Spanish peasantry was crushed by the very wealth their empire extracted. The flight into land and noble titles was the only escape. Those who held gold maintained their status. Those who held silver saw their savings erode before the metal eventually repriced. The social fracture left Spain hollowed out for centuries. Just like the Spanish Empire, the Weimar Republic in 1923 demonstrates the final, accelerated phase of this dynamic. The German Empire had collapsed. Reparations were due in gold marks, or foreign hard currency. The industrial base was crippled. The chosen monetary shortcut was the printing press. The paper mark lost value hourly. Gold vanished from circulation immediately. It went into hiding. It was the ultimate store of value for the industrial tycoons. But silver played a different role. As the paper currency died, the common man scrambled for anything tangible. Silver coinage, silverware, and industrial scrap became the transactional currency of the street. While gold protected the balance sheets of the banks, silver became the lifeline of the street economy. The flight into hard assets was total. Empty apartments in Berlin were sold for ounces of gold. Loaves of bread cost billions of paper marks. The middle class was annihilated. The ratio between gold and silver swung wildly, but both metals infinitely outperformed the paper promise. Stage 1 is fiscal dominance, where the state's debt burden becomes so large that the central bank is forced to suppress interest rates below the rate of inflation to keep the government solvent. Stage 2 is the silent accumulation, where central banks and sovereign wealth funds begin repatriating gold reserves. moving the asset from Western vaults to Eastern capitals, a trend we have observed aggressively since 2022. Stage 3 is the breakout, where gold disconnects from real interest rates and begins to price in the probability of a sovereign debt crisis. Acting as the early warning system for the sophisticated investor, Stage 4 is the silver lag. During this phase, while gold reaches new all-time highs, silver often languishes or trades sideways, confusing the retail public and leading many to believe the metal is broken. This lag is caused by silver's dual nature as an industrial commodity and a monetary metal. In the early stages of a slowdown, industrial demand fears dampen the price. Stage 5 is the recognition. This occurs when the public realizes that inflation is not transitory and that currency debasement is the policy goal, not the policy error. Capital begins to rotate from the expensive leader, gold, into the undervalued laggard, silver. Stage 6 is the slingshot. This is the moment where the gold-to-silver ratio contracts violently. Because the silver market is a tiny fraction of the size of the gold market, even a small amount of capital fleeing into the white metal causes explosive price action. Stage 7 is the reset, where the currency is either redenominated or pegged to a basket of hard assets to restore confidence, stabilizing the ratio at a new, permanently higher plateau relative to the old currency. Just like the Weimar Republic, we are currently witnessing the early to middle phases of this sequence. Current data suggests we are transitioning from Stage 3 to Stage 4. Gold has consistently broken nominal records, driven by central bank buying from nations like China, Poland, and Singapore. The incentive is clear: de-dollarization and sanction-proofing their reserves. However, silver has lagged, creating a gold-to-silver ratio that historically signals a massive coiled spring. The industrial case for silver in 2025 and 2026 is mathematically distinct from history. Solar photovoltaics, electric vehicle contacts, and 5G infrastructure are creating structural deficits. Estimates range widely, but most observers agree that demand outstrips mine supply. One interpretation is that a recession in 2025 will crush industrial demand for silver, causing it to crash while gold rallies. This is the standard deflationary argument. However, this ignores the monetary premium. In a scenario of yield curve control or renewed quantitative easing to bail out sovereign bond markets, the investment demand for silver historically overwhelms the loss of industrial demand. Under these constraints, the rational move for capital is to seek the asset with the highest leverage to currency. Devaluation. If gold is the shield, silver is the sword. The endgame approaches in a fixed order. First, we see controlled decline. This is the phase of financial repression, where inflation is allowed to run hot to burn away the real value of debt. Anchored in the 1940s and 1950s, this period sees negative real rates where holders of bonds are slowly liquidated. Second is chaotic collapse. If confidence in the sovereign bond market evaporates, the currency sheds value rapidly. We saw this in the 1970s sterling crisis. During this phase, the velocity of money increases, and the premium on physical metals decouples from the paper price. Finally, we reach reset and restructure. This inevitably involves a new monetary anchor. Whether it is the Bretton Woods Agreement of 1944 or the Smithsonian Agreement of 1971, the rules are rewritten to favor those who hold real assets. The only variable is timing and pain. Subscribe to this channel. Study the history of monetary ratios. Build resilience in your supply chains. Watch the deficit data, not the headlines.